Good morning, and thank you for joining us for our latest Infrastructure Journal webinar in association with Berman Leighton. Today we'll be debating whether UK pension funds are the solution for long-term financing for infrastructure in the UK. Today's event will be chaired by Mark Richards from VLP. Mark is a partner in the Project and Infrastructure Finance team. He has extensive experience in the infrastructure and PPP market and has worked in a number of high-profile deals advising on equity, debt structures, infrastructure fund trades, leasing structured finance and concession-based structures. Mark is also a non-executive director and global council member of the International Project Finance Association. Before we begin, just a few housekeeping points. Please feel free to submit questions throughout the event. We want an interactive debate as possible, and please use the chat functionality on the GoToMeeting taskbar if you're having trouble hearing us talking. So without further ado, I'll hand it.
Thank you, Sarah. Good morning, everyone, from a very sunny London. And if you're listening to it on the recording, I hope it's still sunny where you are. Welcome to one of, I think, a very important topic in UK infrastructure, the potential role of pension funds going forward in delivering the UK's plans for infrastructure. What I thought I'd briefly do is just set the scene and key themes for this webinar discussion. First thing, really, I think, is really the UK's National Infrastructure Plan, which was published in late 2010 and then refreshed in 2011. I think it was the first attempt by government to really set out a long-term view of UK infrastructure. That plan was welcomed universally, and I think really the detail around it all is really going to be around the implementation. I think the second plan, which is my second theme, is really the desire of government to see long-term new investors and investors providing long-term sources of capital, such as pension funds, getting involved in UK infrastructure through equity and debt investment, and government targeting around £20 billion from those sources. The third theme, I think we can't avoid it, is the regulatory changes and developments in the landscape of infrastructure investment. And I'm not just talking about regulatory changes to asset class themselves, but really to the capital structure, and in particular Basel III, and the effect of Basel III on the bank regulatory framework, and how that's going to impact the shape of the capital structure of UK investment. So against that background, I'm absolutely delighted to welcome four distinguished panellists for our webinar today. We have Joanne Seegers, who is CEO of NAPF and is working at the moment with the Pension Protection Fund in putting together a group of her members and infrastructure fund managers creating a pension fund platform to invest directly into UK brownfield operational infrastructure assets. Morning, Joanne.
Morning.
And Julia Prescott, who's Chief Investment and Strategy Officer of Meridian Infrastructure Fund. Julia, by contrast, is coordinating a group of pension funds and infrastructure fund managers looking at encouraging investment into greenfield UK infrastructure projects, and looking at those both in terms of availability and concession-based structures. Good morning, Julie.
Good morning.
And Duncan Hale from Towers Watson. Duncan advises a large number of pension plans on infrastructure investments and the infrastructure asset class.
Morning.
And Philip. Good morning. Philip heads the infrastructure and PS team at BTMU and covers the EMENA region and provides senior debt and treasury products, a wide variety of UK infrastructure projects and debt advisory services. Thank you, Philip. That's Philip Hall, by the way, for you. So first question to Joanne. Joanne, your members have indicated they're interested in infrastructure, and you've been a great proponent, and the NAPF has been a great proponent in starting a debate on infrastructure and pension fund investment into infrastructure. Why do you think that pension funds aren't piling into infrastructure in the way we think they should be?
Well, I think it's a very good question, because if we look at this, if we take a step back, really infrastructure should be a good natural investment for pension funds. It should be a way of allowing pension funds to match their liabilities and provide inflation-linked returns to pension funds. So you're right, given that it should be a natural asset class for pension funds, and its long-term nature too adds to that, it is curious that pension funds aren't piling in, as you say. But I think there are some good reasons for that, as the market is currently structured. And I think the first thing to say is pension funds are averse to what they perceive as the high manager fees. Now, whenever I talk to managers, they say, no, these things are a thing of the past. But actually, even if it's not 2 and 20, pension funds find those fees simply too high. Pension funds also have an aversion to the high leverage that's currently there embedded in the market. And for pension funds, what that does then is to squeeze out some of the inflation linkage that pension funds need desperately in order to be able to match their liabilities, and which clearly the gilt market isn't providing in sufficient quantity. I think, too, if we look at pension funds and the scale of pension funds in the UK, very many of them don't have the in-house expertise in order to be able to access what is, as I'm discovering, a very complex asset class. And I know some pension funds are prepared to take on the construction risk, and clearly Julia's working with some of those, but very many simply aren't. And again, we're told that there isn't really very much construction risk out there, but nonetheless, pension funds aren't wishing to take that on. So I think for all those reasons, pension funds hitherto haven't found the market one that's really suited to their needs, and that really is the background to the Pensions Infrastructure Platform. What we're trying to do through the Pensions Infrastructure Platform, on behalf of our members, all of our members, and working with the Pension Protection Fund, is to build a new platform, a new fund, which is for pension funds by pension funds, so that pension funds can finally get what they want from this market, so they can access infrastructure in a way that's got a lot of fees attached into it, that there's expertise dedicated to pension funds and aligned with their needs. And throughout the Pension Infrastructure Platform development, we've been trying to create something which is aligned to the long-term interests of pension funds, and which can provide, through having lower leverage, long-term inflation-linked cash returns to pension funds, which is, of course, what we're after as pension funds. And with deals structured to remove some of that construction risk. So I think by combining our efforts, by building a fund for pension funds, by increasing our bidding power, by increasing our presence in the market, then I think we can start to do that. So I think we're making very, very good progress together with the Pension Protection Fund. We've met with a huge amount of enthusiasm from pension schemes. And we are building a new platform which will give those inflation-linked cash returns. We're targeting, as has been reported, a £2 billion fund giving returns of RPI plus 2 to 5. And I think we're making very good progress. And as you can see on the screen there, planning to launch in January next year.
Thanks, Joanne. That's great. And in terms of infrastructure, what does infrastructure mean to your members or those involved in PIP? What do they see as infrastructure? Because it's quite a big asset class.
It is an asset class. I mean, they're looking at availability-based, lower-risk assets. So at the lower-risk end of the spectrum. And again, that's sort of reflected in the sort of returns that pension funds are seeking from this.
Okay, that's great, thank you. By contrast, Julia, you're working with a number of pension funds and infrastructure fund managers on encouraging greenfield investment. And this is a topic that a number of listeners in pre-questions have asked. How do we encourage greater investment from institutional investors, but focusing on pension funds, into greenfield projects?
Yes, I mean, I think one of those, the greenfield aspect of this is a very key area, because clearly in terms of developing something like the National Infrastructure Plan, that relies very much on the creation of a number of new assets out of the ground. And the group of pension funds that we've been working with are really those that have looked at the risk that's constituted by greenfield, either the development side of the risk, the construction side, and ultimately the operation when it moves from greenfield to brownfield. And they've got themselves comfortable with a number of those aspects within construction risk. I think that as translated by more and more studies, and I mentioned that Moody's and S&P, to show that actually the risk involved in early stage construction is maybe not as great and not as frightening as people thought. And when we got the group together and went and talked to the Treasury about this outlook by pension funds into this time of development, I think it was a little bit of a surprise to the Treasury. They've been told that this is a complete no-no. And I agree with Joanne, it's not for everybody, but I think that certain of the pension funds have got have got more engaged in investing in this particular period. And to the extent that we can actually promulgate the idea that construction risk is not the scary beast that some people may think it is, we're very keen to do that. And we feel that the real essential need is to get very early stage investment in from day one, rather than potentially post-construction investment, which will otherwise involve the only other party I can see funding that construction is the government.
That's an interesting point. And Meridian's a great example of a collective investment vehicle which indirectly through pension fund investment and other investors into the Meridian platform takes greenfield investment. Are you a proponent in terms of the greenfield risk? Are you a proponent of the collective investment vehicles being the main way of dealing with that in terms of dealing with concentration risk and geographical diversity? Or do you think there's a possibility of seeing structures where you could have direct investment from pension funds that take greenfield risk?
Yeah, I mean, perhaps I'll unpick some of those, points, because the first one of those is really talking about collective investment structures. And I think that one of the things that we have certainly moved on from is any idea of being a 2 and 20p style model. I mean, I think that was very last year, if I can, in fact, very 2 last years ago. I think people are now putting together funds that actually more reflect the longer-term nature of infrastructure, and therefore they are longer. They're not looking immediately for exits as a result of refinancing. And I think that whilst certainly fees have gone down, I think it's probably going to be a moot point as to whether or not they're actually low enough. But if we're going to get pension funds into greenfield investment through such vehicles, it has to be recognised, I think, that quite a lot of work is required up front to get that early stage investment, that it requires structuring, it requires people time. So there does need to be some type of cost for taking people on board, and I would suggest even with the PIP, the Children's Fund, is going to need to be some type of management fee involved. So I think that it's a question of whether there's always going to be a dynamic as to what is high enough or what is too high. But I think that's certainly one element of it. The next thing is direct investment. I mean, in a number of the investments that we actually have pension funds investing directly alongside us, so it's in parallel. And I think it's one of the things that we'd be very, very keen to promote is to have that type of parallel investment. But it's probably going to be quite difficult for pension funds to invest unless there is a financial investor alongside them, because of the resources and expertise and centralisation required. And finally, I mean, it's just my own book, but I would promote having an idea of a collective investment vehicle for those diversification and concentration issues.
That's great. Well, thanks, Julia. And that really does hopefully address a number of the issues raised by listeners in terms of a myth, I think is the right word to explain it, of pension funds not being able to invest in greenfield projects. Duncan, I'm delighted to have you here because I'm going to pick your brains. I, like many listeners, have been involved in PPP and infrastructure projects, but I haven't had many dealings with infrastructure pension fund plan investors. Firstly, could you sort of outline what the main differences are to dealing with a pension fund investor as opposed to, say, collective investment vehicle? And secondly, if I may, can you explain, because a lot of people have told me, the importance of an organisation such as Taz Watson in terms of the advice you give to pension plans on asset allocation and investment?
Sure. I mean, I think just in terms of kind of managing most people on the call's expectation, I think kind of in terms of kind of the professionals who work in the infrastructure universe, I think it's still very rarely that they will be having direct contact with pension fund investors. I echo Julia's points around kind of the use of collective investments and kind of the professional investment managers. I think for a majority of our clients particularly, a vast majority of our clients, they will still look to access it through some kind of vehicle, whether that be through a traditional investment manager or something similar to the PIP that Joanne was talking about earlier. But I think kind of what will be more important kind of going forward is for kind of those investment professionals working in infrastructure to have a greater understanding of the requirements of pension fund investors. And I think that's kind of the key point. And from a pension fund investor perspective, I think the key thing that they're thinking about when they think about infrastructure versus the whole universe of asset classes that they've got to kind of choose from is thinking about the risk profile. And that's very important. And being able to kind of be able to clearly identify exactly what risks you're looking to take through investing in infrastructure is very important. And I think that's one of the areas where potentially there was a failing over the past few years, where a number of the risks that people thought they were or weren't taking, they ended up not being delivered. So, and I think kind of from that perspective, that's one of the kind of the key roles that Towers Watson has to play. I mean, obviously our clients, as I said, they've got a whole universe of opportunities to look at. Infrastructure is just a potential fraction of what they look at. So we attempt to guide them through thinking about the risks of different asset classes, where infrastructure fits within their portfolio, whether it's an asset that's designed to outperform their liabilities, or whether it's a asset class that's designed to match their liabilities, or whether it's a combination of the two. And I think kind of we're there to help them, guide them through those type of conversations, and also be a conduit between the kind of professionals on one hand that are talking about this at a much more granular level, and pension fund clients who are thinking about potentially more at kind of a top-level risk type of perspective.
Well, that's really helpful. And in terms of your clients and the pension plans that you advise, what do you think that, in general terms, what do you think their attitude is for 2012 is to infrastructure?
Yeah, I mean, I think kind of a number of the kind of the dynamics that Joanne touched on, I think are very much shown in our asset and in our client base. Our clients are very keen with the kind of the idea of infrastructure and what it is supposed to deliver. I think kind of implementation has been difficult up until now. There were a number of investments that happened in kind of the 2006-2007 period, and while in general the performance of kind of the assets, particularly the assets and also the funds in that era have been relatively good, particularly kind of compared to what they were, what we could have got elsewhere in the marketplace. I think that there were a number of disappointments there, and particularly around kind of taking on risks that people didn't think they were going to be taking. So kind of the key kind of thing is there is there's a lot of demand for infrastructure, but the implementation risk at the moment probably leaves a little bit to be desired.
Okay, thank you very much, Duncan. I'll now turn to Philip Hall. Philip, the recent headlines in the FTs have released, PS volumes, particularly in the UK, are down year on year. Although I see from the slide that BTMU is having a stormy year this year, number one on the league tables. In terms of the UK and the volume being down year on year, do you think this can be explained by the predicted or anticipated impact of Basel III, or do you see it as a much wider issue on deal flow and pipeline in the market?
It's a good question, Mark. I mean, I think Basel III is clearly not helping. But I do personally believe there's probably a number of banks out there that are actually using it as an excuse, or a bit of a smokescreen to cover up for some of their other underlying issues, wherever they may be. I mean, all banks, or many banks, are clearly sort of deleveraging, looking to sell off large chunks of their assets. I mean, I think we're all aware that cost of funding for many of these institutions is on the increase, certainly for long-term funding requirements. So, not dismissing the impact of Basel III, but I don't think it's the root of all evil, as far as many banks are concerned. I mean, to some extent, or to a large extent, the pipeline is clearly driven more by government policy. I mean, in the UK, we've clearly got the whole debate around the TFI reform as well. So, to some extent, all these impacts put things on hold for a while everyone works out what the new outlook is going to look like. Central and local government budgets being cut clearly has an impact on the ability to create new infrastructure opportunities to go forward. So I think all of these things are actually impacting on deal flow rather than just Basel III.
Thanks, Philip. You've like me, had the opportunity to hear the responses from the other panellists on the potential and the current role of institutional investment investment, particularly pension plans in UK infrastructure. Where do you see, if I don't mind say, traditional commercial bank debt funding sitting with institutional investors? Are they good bedfellows? Can they be complementary, or are they completely separate markets here?
I think they're absolutely complementary, actually. I mean, I guess a lot of people probably think, given, I mean, you've already alluded to the league tables, but given our sort of position in the market, we would be concerned or threatened by new long-term funding. We're not in the slightest. We actually think, well, to start with, we want more players coming in to ensure that these infrastructure assets get delivered. Banks, rightly or wrongly, are perceived as good at due diligence, risk assessment, structuring skills, all of these things which some of the other speakers have already touched on. Pension funds perhaps don't quite yet have. So there's absolutely no reason why we shouldn't work together. And I guess the question is how that happens in practice. I guess for an institution like ourselves who's still very much open for long-term lending, we'd be more than happy to work alongside these institutions together on a long-term basis. And similarly, we're certainly not averse to doing short-term lending, as are many other banks preferring to do. So we could equally work alongside some kind of short-term construction with phasing and then flip it into some other vehicle. So I see that the two should work perfectly well in tandem, and I think that's the model we should also be trying to work towards and promote.
Well, thanks, Philip. And I'm going to touch on that a little bit further in sort of alternatives for senior debt funding, and I'll open this out to both yourself, Philip, and to Judy as well. Finally, this week we've got the EU approval on the EU Project Bonds Initiative, not the Euro Bonds Initiative, I might add. any German listeners, not definitely project bonds. And set aside 230 million euros or thereabouts, and thank you to my fellow panellists who've done the maths for me, leveraging up to around about 4.5 billion euros in terms of potential project pipeline there. Open question to you both. Do you see this initiative positively? But do you see, and even if it is positive, do you see this making a big impact on the infrastructure market across Europe? Judith?
Yes, I'd have to say that we are positive about the Project Bond initiative from the EU and the EIB. I think that one of the most exciting features about it is the fact that it is promoting capital markets investment into infrastructure. I think that the potential is probably going to be more continental European based than UK based. And apart from the whole Euro issue, which is a fairly key part of that, the concept behind the Project Bond Initiative, which is much of anything to stimulate the capital markets, is the need to stimulate those continental European capital markets. The structure itself, I think we need to see a bit more of the detail on. I'm slightly concerned at the moment that it looks as though it's trying to be some read across from the EIB's LGTT facilities, and I think that actually it probably needs to be very much more focused on a more comprehensive approach to projects, and also a more comprehensive approach in the context of both looking at availability and user paid, because obviously LGTT was focused on the user paid. The other issue that I'd say with it is it's obviously a guarantee facility.
Yeah.
And I'm sure Philip will to comment on this, but because it doesn't seem to be actually providing additional liquidity, and I believe that liquidity could also be beneficial as well as the pure guarantee aspect of it. So we're very supportive of it. We'd like to see projects, and indeed some of the projects that we mentioned already are ones that we're working on currently as being pilot projects for the Bond Initiative. We'd like to see things work. I suppose the final point that I would make is that as well as just providing it as an offering, I think it's very important that the investors are also gathered up behind the Project Bond Initiative. It's not just there, and thank you very much indeed, and all the investors are going to walk in the door. It's there as a start, as a stimulus, and a lot of follow-up now needs to take place.
Just picking up on that point, do you see a potential as a sponsor? Do you potentially see an execution risk issue then on the Project Bonds Initiative? If clearly there's 20% there for from the EIB. That's all very exciting, and the credit analysis of that guarantee is something that Philip can touch on. But generally speaking, you still have to get a bond away. Is that a concern for you from the spot?
Well, I don't think we'd be entering into bond financed projects unless we knew that we were going to get the investors behind us. And I would like, that's why I'm saying it's as important to work with the investors to make sure they're comfortable with the process. I don't think you can just give a project bond guarantee, or indeed a cash contribution. I mean, in a way, I guess we have a feeling that it might be more beneficial to have that cash as well coming in as the guarantee. So you're certainly going to need to make sure that your investors are very well in place in terms of where they're going.
Thanks, Julia. Philip, any views on the project bond initiative?
Yeah, I mean, I'd agree with everything Julia just said. I guess the point about the guarantee or the actual direct lending on cash, I mean, you're right, everyone prefers cash rather than guarantee, but I do think the guarantee will open up additional liquidity for banks who wouldn't otherwise lend without a guarantee in place. I guess the other area I just wanted to touch on was, I think, on the sort of government or the procurement authority side, there needs to be a change of thinking as well in terms of how they're going to run the structure the contract and actually run the tender process as well. Clearly the frameworks at the moment don't really allow for investors or sponsors actually trying to promote a bond solution. And I think it comes through in a number of areas in terms of weighted cost issues, evaluation of the bond spread risk. Clearly with bank financing you've got a much clearer idea of what the final price is going to be, whereas on the bond side that's less clear cut until the end.
Yep.
And I think what they need to see is promote a few more sort of pathfinder type deals, which I think is happening more on the continent. Holland's doing it, other places are doing it. And whether the states or the authorities actually force bidders to submit some kind of mandatory bond variant to actually stimulate this whole process. Otherwise, I think it's quite a tall ask for bidders to do that without some kind of perceived benefit from the state.
Yeah.
I mean, I'd like to really back up that point about the requirement to have a bond at the time of a bid, a bond being required as well as the bank financing, because I think that stimulus is sometimes needs to be more than self-generated. I think it needs to be, this idea needs to be imposed, and an awful lot of people would do an awful lot more work on a bond variant if they had to. And I think talking about Canada, I think that's something where it's actually been made very clear that bonds are going to be preferable to banks, but you can still put in a vote, and you get a lot of bond financing as a result. So it's both a push and a pull, really, to get this funding away. But with great respect to Philip, and we're greatest supporters of Philip's activities, that he's rather sort of fewer on the ground than he used to be in terms of the bank being prepared to make long-term financing available. So I think we really need to look very seriously at that now, and it's very much the case that people are, as an alternative to bank financing for long-term infrastructure.
I think one of the problems there is at the moment there hasn't actually been any deals that sort of fallen over. I mean, everyone talks about liquidity drying up in the bank market. So it's a little bit neck and neck, and if you wait for a couple of deals to fail to actually deliver, and then the government wakes up and says, well, actually, we do need to find another solution, or do we try and be more proactive and prevent that before it happens? I think that's one of the issues at the moment.
And it was interesting, all the good work that Andy Rose and my client did in TIFU, that was at a very particular time in the market, and ultimately they wrote one check. But do we need to get to that point in time before that happens again? So it's interesting to hear those, for want of a better expression, Achilles' heels for potential bond financing. Fixed income investors used to like Monline wrap deals. They used to like the AAA, they used to like the amortizing stuff. It was great. That world has gone, and we're now into a brave new world of potentially unwrapped, credit-enhanced projects, underlying credit enhancement rather than the credit enhancement from Monline or insure of that nature. Although for anyone listening from Assured Guarantee, I appreciate you're still offering that product. But in the round, we were expecting senior bonds to be unwrapped. How important do you see the capital markets going forward? Maybe not in the next year, but maybe in the next 5-10 years. Julia, do you see us ever getting to a capital market like they have in Canada?
I would very much hope so. I think it's as both Jan and Duncan said, I think that the long-term defensive nature of infrastructure cash flows is particularly suitable for pension funds and also insurance company investors, because it gives them that chance to do the asset liability match in really quite an effective way. And that's why we are very supportive of the extent to which capital markets products can be introduced. And I would hope certainly that within a 5 to 10 year period that the type of offerings that we now see in Canada will be as common in the UK market. I think it's going to take a little bit of time for people to get used to the idea, but if we see 1 or 2 deals that work and get away, these will form the paradigm for future investment. I think it's exciting.
And in terms of government support, I'm in final agreement with you all in terms of the desire to create some kind of pathfinder projects, and perhaps to even mandate when you're going out to bank, go out for bonds as well as a shadow over a certain price limit. I suspect the Priority Schools programme at 80 million below are probably not going to be the ones to be bothered with that.
There is the size issue.
Yeah, there is the size issue. That's the side. I mean, ultimately, the capital markets do need, we need a flow. Is it the case that we just don't have the deal flow in the UK to get the capital market investors interested to spend the time and effort to look at those particular assets, those particular bits of paper, or?
Well, I mean, the whole deal flow in the UK question is an entirely different one. I suspect if we had more deal flow in the UK, then it would be something that certainly you could get capital markets more interested in, because there would be more opportunity to look at different types of options and fundings. But I think certainly from the Duncan, what more is going to be required? Do we need to have a set piece, as it were, as a first project to get the institutional investors really enthused about long-term debt? I think that's it.
Yeah, I think kind of long-term debt is a very interesting piece of the infrastructure puzzle, and one that has become, I think, increasingly important to our clients. Access, again, very, very important, and obviously a capital market solution would be, I guess, a bit easier for our clients when they're very, very used to investing in liquid debt instruments, and have got significant kind of relationships with a number of the large managers in that space. But they're also looking at kind of private debt also as another option. Again, kind of the vehicles there have traditionally suffered a little bit from what the equity vehicles have suffered from, in terms of not being particularly set up in a way to deliver exactly what the clients, kind of institutional clients are after. But I think that's rapidly changing in the same way as the kind of equity funds are changing. And from that basis, we are seeing quite a lot of interest at the moment from our clients to invest in infrastructure debt. I think, though, just kind of going on in terms of whether that will be sit in greenfield or kind of brownfield, I think kind of while you might argue that our clients might get there with greenfield equity, I think it's a long way away before our clients will get there with this kind of greenfield.
Do you think that's sort of do though with ratings? And when you say greenfield, I mean, something could be greenfield but rated A, or something could be brownfield and rated BBB. Is it with debt? Is it more the rating that you would ascribe to it?
It's probably, it's probably a reflection of the rating. Yes, you're right.
So if you could, which is one of the ideas behind the Project Bond, which is lifting up that rating to be an A, and presumably one could also get the capital markets investors.
Yeah, I think that's. I think that's right. Again, it would be. I think that would be a decision that our clients would outsource to a professional investment manager.
Yeah.
And lastly, on sort of capital markets, agree again. Incentives on pathfinders, maybe getting mandatory bank bonds bids in for decent-sized projects. But do states do it slightly. They do it slightly differently. There are elements of tax incentives on debt instruments and infrastructure. Do you think there's any mileage or any desire of government to provide some kind of tax incentives for long-term debt, or do they?
Wouldn't that be wonderful?
I'm not sure that it was tax or incentives. The government at the moment on anything. Who knows what might happen in the future? But I suspect at the moment that isn't something which would go down terribly well within Treasury. But they clearly need to think about how how the market will develop and how they will attract investors, including institutional investors like pension funds.
And again, it probably comes down to the fact long-term view that pension plans take. If those tax incentives are so important for an investment decision, if they were to be taken away, then that would again create.
And the history of pension tax incentives or tax relief for pension fund investment are not happy with.
No, it's not a great.
I think the way rather without it, but maybe this is part of the way in which government can reinvigorate occupational pensions. Who knows?
I'm going to turn to Duncan and Joanne next. Your dealings with your members and the pension plans, do they, and this has come across with a number of questions that have come now and come earlier to me, do they express a preference in taking a pure equity position or a sort of traditional leveraged equity position? Or are some pension funds expressing a preference to just take a credit position or a debt position? There's been a lot of talk in the press and even Treasury talking about, well, people should take an unleveraged position. Any thoughts on that?
Yeah, I mean, I think kind of this is very much kind of got to look at client and geographical kind of context, and I think kind of particularly if you look at UK pension funds and you look at them in the round in terms of their asset allocation, they've got a large proportion of their asset allocation in gilts. So essentially what they're looking to do is basically lend to the government at basically nothing. And then they've got this, and then they've got this infrastructure, potentially got this infrastructure asset that's got a government guaranteed cash flow, and you're saying that
not guaranteed.
Sorry, government backed. Sorry, but I'm not being very general here. But government backed cash flow that they're looking to kind of have to borrow against at quite a significant margin. So in the context of that, I think a lot of our clients in the UK are looking at significantly lower leverage levels within their portfolio, potentially even, as you said, an unlevered position. I mean, that's different around the world.
Yeah.
Our clients in places like Australia and Canada and Asia are not looking for kind of those unleveraged positions. They're still happy to take a degree of leverage. I think it's fair to say, though, wherever you are around the world, the kind of the levels of leverage that you saw kind of 2006, 2008 are no longer appropriate anywhere. But it kind of the level of how severe that requirement is to delever is very client specific and geographic.
Yeah, and I'd agree with that. And as we've sort of gotten through the process of working up the structure for the pensions infrastructure platform for the PIP, we've had lots of discussions with our members about leverage and how much leverage you would be prepared to accept. And some said, well, there is a sort of option that says no leverage at all, but actually recognising that probably some leverage is right. And so that's why we've said, it's been reported on, that we've said, 50-50 leverage, up to 50% leverage rather, per project and across the fund. So lower leverage is what funds are after, for precisely the reasons that Duncan talked about, and that sort of 89% leverage is simply not what pension funds are after, because they want the inflation linking and they want the returns on inflation linking, and they simply cannot get that from the gilts market at the moment. Even if index linkers were providing something like a positive return, there simply aren't enough to meet pension funds demand.
And I think it kind of goes back to kind of where infrastructure is evolving to in a number of clients' minds about whether it is a growth asset or one of those assets that are there to outperform their liabilities, or whether it's something to match.
And certainly, the members that we've spoken to and those that we're working with, and they're by and large the very largest pension funds so far, but we want this fund, and it will be open to all pension funds of all sizes. What they're after is something which can help them match their liabilities. Our DB pension funds, unlike in Canada, unlike in other parts of the world, are by and large closed-time pension schemes, and so those funds are looking to be able to match their liabilities. So it's very much in that matching, not the growth asset as well.
Okay.
I mean, there's one point I'd like to just pick up on that, which I think is interesting, is this idea of inflation linkage, because certainly the sort of assets that seem attractive to pension funds, which are the classic sort of availability ones. In fact, it's actually the whole cash flow which is inflated when you look at it. So actually, if your focus is on inflation, actually attaching to inflation-linked cash flows, you get the whole lot. But if your focus is on risk, and the leverage is so much more about risk than it is about inflation linkage in a way, clearly we've managed to have very high levels of leverage because of the fact that the perception of it's relatively low risk that we're looking at, so we can therefore bring down the weighted average cost of capital as an example. So it just, it seems to me that the whole leverage question is one in which maybe one brings it back to risk rather than necessarily inflation linkage. I bet I'm interested in Philip's view on the sort of leverage question.
I agree, as everyone was talking, I was probably thinking not similar thoughts to Julia. I mean, I suppose if it's less leveraged or deleveraged, that ultimately helps with the rating. Obviously, the rating of the project, if you've got less debt in there, so maybe that then helps get pension funds more comfortable. Rather than the risk or the weighted average cost of capital. So I can see the logic for more equity, less debt, improves, gets you closer to that sort of typical A rating, which then makes it more attractive generally. Yeah.
Yeah, I think
but I mean, I did take your point. I think there is, a large amount of the discussion is around lowering the kind of the overall risk of the project. Regarding the inflation aspect of it, I think I'll go back to the comment I made at the start, that the kind of a greater understanding of what pension funds are after is required from the overall industry. And if things that can be developed that provide the type of things that Joanne and myself have been talking about, I think we'll have a lot more investment into this asset class.
I think that's actually a sort of bit of a boost to greenfield, because obviously a lot of the brownfield availability assets, that inflation has now been swapped out. It's only when you get the new elements coming on, and then there's the question of, in the future, how much cash flow is going to be inflated, but assuming that you have the same sort of picture, then you actually can get access to that new inflation linkage.
I think that's a real comment.
And a question from the listeners. This is sometimes some of the simplest questions are the hardest. So I'm going to ask them. But again, there does seem to be a theme across this, which I think hopefully a lot of people are taking away, particularly me, that there needs to be a greater understanding of what pension funds want. It's such a simple concept, but I think hopefully that drills across this webinar. But one question being that some pension funds invest in infra equity, leveraged or unleveraged, but some don't invest in debt. What decision processes do they go through to say, I'm not taking a credit position, I want a levered equity position, or I want an unleveraged equity position?
It's again kind of very quite specific. So the key thing that they would do is look at their overall asset allocation as the first step. And I think what we've seen generally has been that our clients have got large positions in matching assets, so gilts and swaps and that type of thing, and that traditionally they've had large positions in things like equities. So the way that the kind of infrastructure, the genesis of infrastructure 5 or 6 years ago was around, let's find ways to diversify that equity risk. So the natural kind of position for someone to invest if they're looking to diversify their kind of listed equity risk is to invest in equity positions. Something that's got a similar type of return, a different risk profile. As the kind of the thinking is developing, and Joanne's articulated it well, the kind of people are looking to move down the risk spectrum and thinking about it more from a matching perspective. And so that's the discussion that's the key discussion that you have with a client around what type of product they should be investing in. what exactly they're trying to achieve, and kind of that will very neatly lead you to deciding to invest in A or B.
Okay. And it will very much depend on where pension funds are on the spectrum of open to closed, how close to the so-called end game they actually are, and the individual pension funds, membership profile, if you like. So I think that sort of genesis of equity to debt that Douglas described is right.
And on the sort of leverage or capital structure, the lawyer here, so I must be careful. You deleverage, potentially your weighted average cost of capital increases, potentially, and that may impact on ultimate returns. Just very simplistically, a very high level. Effectively, there has to be boundaries by which pension funds say, actually, that's too low for me, I'm going to put it into X, into Y. Leverage isn't the end game, it's return, isn't it?
Yeah, I mean, it's return and risk.
Yeah.
I mean, I don't think that there's any, I think our clients understand that if they want a lower risk profile than what has traditionally been in the past, then they're going to have to accept the lower risk, and lower return.
Yeah.
And they fully understand that, and kind of from our, I mean, we recognise that kind of there'll be different things that are appropriate for different types of investors. Institutional investors, I think, are after a lower risk return. We understand that isn't appropriate for everyone, and so therefore this type of structure isn't going to be the only game in town. So this type of structure can't have a significantly different weighted cost of capital to anyone else. Okay.
And so again, in terms of where we've got to, I talked earlier about we're after an RPR plus 2 to 5. That has been the consensus around the members that we've talked to in terms of the sort of returns that they're looking for. What they want are low risk, and they accept therefore lower returns, long-term inflation-linked cash returns to the fund. And that's because of really both of the structures described. That's where the pension funds that we're speaking to are seeing this particular asset class, and where they see the PIP providing a really good service on the pension fund terms.
I mean, can I ask them, I mean, that's clearly an area, it's a certain sort of RPA 2 to 5. And, possibly when you look at debt, I'll go 5, sounds rather exciting, doesn't it? It all sounds a lot more exciting than good. But when you look at a sort of single platform, you could say, well, that is a debt, it's an aspiration for debt, and it could be quite interesting. But if there's an equity link into that, clearly there's that first loss aspect of it, that equity is going to have a potential loss associated with it in terms of the waterfall of the cash flow. The equity loss is going to be paid off. So I just wonder whether or not it's possible to get a completely single project cash flow on an unleveraged basis within a single vehicle. Or whether or not you just say, well, actually, that's my 80% of the cash flow vehicle, or my 70%, or whatever it is. Because equity does have a different risk. I mean, clearly, it is priced, and people do lose money. I think the equity providers into Cornwall schools might be
no risk. We're not saying no risk.
Yeah, no. I mean, again, I think kind of, again, it comes back to kind of understanding risk profiles, and that is what kind of the trustees of our clients do on a day-to-day basis.
Indeed.
Look at the risk profile of infrastructure versus the risk profile of gilts versus listed equities, and kind of that's the type of thing that they would take into consideration.
And pension fund trustees have got much more sophistication in doing that.
Yeah, definitely. Yeah, for sure. Yeah.
Okay, well, we're coming towards the last 10 minutes of the webinar, so I thought I'd just start to talk about the role of government, really. We've had some...
might take longer than
we've had some... please everyone sound for a bit longer. But we've had some interesting developments this week with Nick Clegg, quite an interesting discussion with the FT around growth, stimulus to the economy, and talking very positively about infrastructure. And in particular, I thought it was really interesting to see him talking about Treasury and how there is some discussion at the very highest level of government that perhaps Treasury should be less worried about the use of UK PLC's balance sheet and its credit strength to help get some projects away. That's all very interesting. And if I just juxtaposition that, because I think it is a positive thing. I think the UK infrastructure should be applauded. I think they've been very visible in the market in terms of the need to get engagement with pension funds and long-term investors. The questions come from someone yesterday was, government think it's a bit of a demand problem, this, but actually is it more of a supply issue? And I think that really comes down to the discussions we had earlier about pipeline, which we can probably touch on in a moment. But do you think there's anything more that government could be doing to attract alternative long-term investors, in particular because we're talking about pension plans? And yeah, we'll open that question for everyone, really.
Well, can I perhaps start by first explaining what the role of government is in relation to the PIP?
Yeah, of course.
Because clearly that has its basis in an MOU that we signed with Infrastructure UK and the Pension Protection Fund. But I want to make it very, very clear to people who are listening that the government won't have any role in the PIP. It's not going to be involved in setting the terms of the PIP, and neither will it be involved in setting where the pension funds invest. So I think it's very important to say that at the outset this will be a fund for the pension funds by the pension funds, and it's very, very clear to get that across. But I think where government can play a role in encouraging pension funds is to think about things like how to structure the contracts. How can it help that, we've talked a lot about construction risk, but how can it help to manage political risk? If what pension funds want are long-term investments, we're not into the buy it or flip it model here. If what pension funds are longer-term investments, what can government do to help manage some of the political risk in that? How can it structure the contracts in a way that's more suited to pension funds' needs? For example, taking account of the fact that there's lower leverage in some of these, from some of the suppliers of capital.
I mean, I'd really like to echo Ryan's point there in relation to contractual cash flows. And I think one of the reasons why certainly the group of pension funds that we got together to talk to the Treasury is to say that the type of model that we see, and I'm not going to use those dreaded words, PFI, and things like that, but that type of model is something that actually we felt the pension fund community had become quite comfortable with, that the whole contracted nature of the cash flow has reduced that political risk in terms of obviously the issues in relation to what happens on termination, and that makes it an attractive type of investment. So in a way, oh please government, don't take away the thing that the pension funds have just got comfortable with in order to replace it with something else that they're not going to be as comfortable with, or they're going to take time to get used to making investments with. And I think that therefore, if government can do anything, it's actually to look at what has proved to be potential investment structure to date.
Yeah, no, I could echo that too. And it's an interesting fund because they're trying to bring in new long-term providers of liquidity. At the same time, they're looking to reform the whole PFI type framework, which has been in place for the best part of the last 2 decades. And I know you touched on Cornwall schools earlier as an example where people lose money, but I mean, how many closed deals are now? 780 of them?
Yeah.
On the existing framework. I think there's probably a handful of deals you can all think of where investors have actually lost money. So I think that would have been a good, if you spoke to pension funds, they'd look at the last 775 deals, all got through construction, etc., all looking generally pretty good. And at the same time now, we've got the government reforming the whole framework. So I think it's an interesting time.
So to please the government, don't...
Well, don't sort of mess it up too much, I guess.
And I think so, just going even further on that, I think there needs to be a bit more of an effort made to pry out the benefits of kind of this type of investment. I mean, a number of the conversations that I have with my clients start off with a 10-minute, well, is PFI going to be around? Are the government's going to renege on their contracts?
And what might future governments do?
Yeah, what might,
and governments always say, well, this government can't blame future governments, but actually, and it's a constant dilemma for pension funds, our time horizons far extend those of politicians. We have to which may be good or may be bad, but there's sort of not just what this government does, it's what future governments do as well.
So I think kind of showing some support and kind of trumpeting the benefits of this, I think would be very helpful. There are some mixed messages that go out, and kind of trustees do pick them up. And in the context of a universe of investment opportunities out there, often trustees are looking for a reason to say no rather than to say yes. And this often will provide them with kind of the reason to do that. So I think that's probably a key thing for a message that kind of a single voice is.
I mean, I think we're not necessarily, I mean, certainly the group that we were working with isn't actually saying, you know, it must stay exactly as it is, and I've actually come forward with a number of suggestions to potentially improve the risk relationship and also the perceptions of the public and private side working together. It's just the underlying concept has worked pretty well. It sounds the sort of thing that the pit would want to invest in, certainly that you know, us as funding members as pension funds, we like the concept.
I think that's one of the challenges that we have is actually finding good data about kind of actually how these things perform. I mean, you can kind of go through and pick out individual projects that have done poorly, but I mean, actually, in the wash, as you said, most of them have done very well. The actual operational performance of these assets, from an anecdotal level, when we're talking to people involved in the market, seems very, very strong. But if we get some data that kind of shows that.
I mean, I think the really attractive thing about pension funds and the really positive benefit to government is the fact that they are long-term players. And so I think
that kind of then needs to be recognised.
And I think that needs to be recognised. They're not going to flip. We're not going to have the famous fat cat return, the people shifting on at the end of construction and actually flipping and making a huge percentage at that stage. And that needs to be stressed again and again. You know, if you get this new class of investor in on a suitable risk profile, it's going to be very beneficial in terms of other aspects of infrastructure investment.
So that's a great point Duncan made as well on data. I think we with my IPFA hat on, we submitted some data into government and suggested that we should be more collection of data in terms of contractual performance. The NAO have been very good at looking at PFI and PPP, probably more. They've looked at more PFI and PPP than any other asset class, I'd say. But I think getting the raw data down, I'm sure, would help your clients and your members. Just wrapping up, just wanted to get your final thoughts and predictions on the role of pension funds in UK infrastructure over the next 12 to 18 months. Positive, any thoughts, Julia?
Give us the deal. I mean, I think, you know, the extent to which it's going to be a lot of pension fund involvement is going to relate to the number of deals that come down the UK pipeline. Delighted that the schools came out yesterday, but, you know, it's only the start of the schools coming out. You know, we'll see what the model is. I think that there's only more, you know, the more opportunity for making investments, the more chances of getting to pension funds.
So supply, don't worry about demand.
I think it's a supply issue.
Joanne?
Well, I think it's going to be very exciting 12 to 18 months for pension funds as concerns infrastructure. I think, you know, we, those who are developing the PIC, will see us a real leap forward. And I think if we can, you know, make sure that the market is better suited to pension funds' needs, then I think, you know, it will be very exciting. And I think pension funds will find that they can access this asset class much more helpfully.
Okay. Philip, thoughts?
Yeah, I mean, I guess the cynic in me says it's been talked about for a number of years. I mean, the lead came out in 2008 and it's talked about every single year, sort of many conferences to your attention, how do we get pension funds and insurance companies. But I do actually think, you know, this year there seems to be much more momentum and support behind the whole initiative. I think that coupled with, you know, banks, as you said, sort of generally withdrawing from long-term lending. I think if it doesn't happen this year or the next 12, 18 months, then it's not going to happen. So I think we need to capitalise on this momentum.
Duncan?
Yeah, I think pension funds will be an increasing part of the solution. I think that will ever be the complete solution. But over the next 12 to 18 months, I imagine that kind of it will be increasing, and I can see kind of over the next 3 to 5 years it increasing even further.
Well, that's great. Well, thank you very much. I think we've got all can take away a real positive end message, which is that if the deals are out there, and they're appropriately structured, pension funds will actively look at them and look to be investing and be long-term investors, and shoulder to shoulder with those long-term investors are our banks and capital market solutions to help to the extent appropriate with leverage as well. It's been a really interesting debate. Thank you very much. Julia, thank you.
Thank you.
Joanne, thank you very much. Philip, thank you. And Duncan, thank you very much. And thank you to all the listeners, and thank you very much for all your questions. We got through a few of them, and hopefully you found the debate very useful. Thank you. Goodbye.
Thanks. The webinar's now over. Hope you enjoyed the session. Thanks very much to Mark from VLP. Any questions that we didn't get around to, we've got your details, and we'll be in touch with you. Thanks very much.